Bitcoin right now is sitting at $78,100, and the silence is deafening. The daily trend is screaming sell, the 5-hour trend is a strong sell, and yet the funding rate on every major exchange just flipped deeply negative for the first time in 3 weeks. That means the crowd, retail traders, leveraged degens, the same people who always get run over, they're piling into shorts right at the very moment the S&P 500 futures are testing a critical gamma flip level that could ignite a face-ripping rally. Is this a massive bear trap before a launch straight through 80,000? Or is it the final distribution before gravity takes us back to 76,000 and beyond? There is one danger zone and one hidden opportunity today. I'm going to show you both. Stay until the end because I'm giving out 3 exact entry and exit levels you can plug into your platform right now and walk away with a clear plan. Write this number down, 77,484. That is the line in the sand. A 4-hour candle close below 77,484, and the entire bearish structure accelerates, the trapdoor opens, and we are likely heading straight for 76,812, and then possibly 74,000 in a matter of days. But as long as we hold above 77,484, my session bias today is a range fade with an upside lean. I'm not chasing the breakdown. I'm looking for the bear trap to snapshot. The invalidation for any bullish thesis is precisely that, a decisive 4-hour close below 77,484. If you see that, you scrap the long idea and you join the momentum. Until then, I'm fading the fear. Let's go top down, because the higher timeframes always control the destination. Pull up your weekly chart. Bitcoin printed a nasty rejection from the $80,000 zone 2 weeks ago, creating a lower high against the March peak. The weekly MACD has just crossed bearish, and the histogram is expanding to the downside for the first time since January. But here's what most traders miss. Price is still comfortably above the 200-week moving average, which sits around 47,000 and has been rising steadily. That's the structural flaw. On a daily time frame, things get more interesting. We are below both the 20-day and 60-day moving averages. The 20-day is roughly 79,200. The 60-day is up near 83,000. The 200-day moving average, however, is way down at 72,000, and it's been a launch pad every time we've tested it this cycle. The daily MACD is in negative territory, but look closely at the histogram. The bars are shrinking. Bearish momentum is decelerating. It's not a bullish flip yet, but it's warning us that the trend is tired. When a trend gets tired near a major support zone, smart money starts licking its lips. Now drill down to the 4-hour chart. Because this is where the trap is being set. We've been grinding lower inside a descending channel for the past week. Yesterday we touched just under 77,500 and immediately bounced, forming a little higher low compared to the spike down to 77,200 we saw 3 days ago. The 4-hour 20-period moving average has flattened at 78,400, and price is currently hugging it. The 60-period moving average on this time frame is declining right around 79,000, acting as dynamic resistance. The 200-period moving average on the 4-hour is still elevated at 82,000, not yet in play. But the critical signal is the MACD. On the 4-hour, we have a clear bullish divergence. Price made a lower low at 77,200, but the MACD histogram made a higher low. It's not a secret, it's right there on the chart, but most retail traders are ignoring it because the daily trend is bearish. This divergence suggests that selling pressure is exhausting. We often see this pattern right before a short squeeze, especially when positioning gets lopsided. The key resistance levels above are 79,025 and 79,893. Those are the gates the bulls must break. On the downside, firm support sits at 77,484, with a secondary shelf at 76,812. If you're scalping on the 1-hour chart, the 60-minute moving averages are all in a bearish alignment, MA20 below MA60 below MA200, confirming the intraday downtrend, but that's exactly what a bear trap looks like before the reversal. It looks the most bearish right before it rips. Here's what most traders miss. The cross-asset linkage with the S&P 500 is screaming louder than Bitcoin's own chart right now. Over the past 48 hours, the S&P 500 has bounced hard off its 100-day moving average, finding support at 5,200 and pushing back above 5,280. On the 4-hour chart, the S&P is printing a potential double bottom with RSI bullish divergence, almost a mirror image of Bitcoin's setup, except the S&P is already turning up. Bitcoin is lagging. That lag is not weakness. It's a rubber band being stretched. Historically, when the S&P leads and Bitcoin hesitates at a support zone with negative funding, Bitcoin plays catch-up violently. The funding rate story is the match that could light this powder keg. Right now on Binance, Bybit, OKX, the perpetual swap funding rate is solidly negative, averaging minus 0.01% across the board. That means short positions are paying longs just to stay in the trade. When funding stays negative for an extended period, it indicates an overcrowded short. Market makers know exactly where those stops are sitting. A push above the 4-hour 60-period moving average at 79,000 would likely trigger a cascade of short liquidations, fueling a rapid spike toward 80,000. We've seen this script play out at least 4 times this year. The crowd gets bearish, funding flips negative, and then a single 4-hour candle wipes them out. The 24-hour news flow hasn't delivered any Bitcoin-specific catalyst, but the macro backdrop is shifting under the surface. Bond yields dipped yesterday after a softer-than-expected manufacturing PMI, and real yields, the most important driver for scarce digital assets, ticked lower. Gold is holding firm near its highs, and the dollar index is struggling to reclaim 105. These are risk-on undercurrents that Bitcoin eventually responds to. On the institutional flow side, spot Bitcoin ETFs saw another day of net outflows yesterday, around $120 million, but the pace of outflows is decelerating from the 200 million plus days we saw last week. This suggests the passive sellers are exhausting. Once ETF flows flip to neutral or positive, the spot bid returns. The 1 to 2 week directional lean, therefore, is cautiously bullish above 77,484. I expect a grind back toward 80,500, as long as the S&P 500 holds 5,200 funding remains negative. The thesis invalidates on a daily close below 76,800. That would mean the ETF outflows are accelerating again. The S&P has lost its support, and the trap has failed. In that scenario, 74,000 is quickly in play. Most people will skip this next part, but this is where money is made. Keep watching because I'm about to hand you 3 fully mapped trade setups with exact triggers, stops, and risk-reward calculations. Do not trade these blindly. Wait for the conditions to align. Strategy 1, the sniper. This is the conservative setup for those who want confirmation before committing capital. Your trigger is a 4-hour candle close above 79,025. That's the level that has capped every bounce for the past 5 days. A body close above it flips it from resistance to support and confirms the bear trap has sprung. Entry on the candle close, with a stop loss at 78,250, just below the 4-hour 20-period moving average and the recent consolidation midpoint. Your initial risk is about $775 per Bitcoin. Target 1 is 79,893, the next major swing high. That's a 1-to-1.12 risk-reward, nothing spectacular, but it's high probability. Target 2 is 81,200, which aligns with the prior breakdown level from 3 weeks ago and the 50% retracement of the entire recent decline. That gives you a risk-reward of roughly 2.8 to 1. What voids this setup? If price pokes above 79.25 but fails to close on the 4-hour, and instead wicks back below 78,800, stay out. The sniper waits for the clean body close. No confirmation, no trade. Strategy 2, the active trader. This one leans into the funding rate squeeze before the breakout becomes obvious. You're looking for a sweep of the liquidity resting below 77,700. We often see a fake-out dump to grab stops just under that level, followed by a violent engulfing candle on the 1-hour chart. Your entry trigger is a 1-hour candle close back above 78,100 after such a sweep. That confirms the rejection. Place your stop loss at 77,350, just beneath the sweep low. That's a $350 to $400 risk, very manageable. Target 1 is 79,025, offering a near 1 to 2.5 reward. Once target 1 is hit, move your stop to break even and let the rest ride. Target 2 is 79,893, giving you roughly a 1 to 4 risk reward on the full move. This setup thrives on the negative funding dynamic. When shorts get trapped below 77,700 and the price rockets back through 78,000, the panic closeouts do the heavy lifting for you. Now, let's see how aligned we are. Type your Bitcoin trading range for tomorrow in the comments right now. Be specific, something like 77,800 to 79,300. I'm reading every single one, and I'll pin the most accurate call in tomorrow's video. Strategy 3, the aggressor. This is the high-risk counter-trend short, only for those who know how to lose small and manage risk aggressively. If Bitcoin spikes into the 79,800 to 79,900 resistance zone and prints a clear bearish rejection wick on the 15-minute chart, ideally with a bearish divergence on the 15-minute RSI, you can fire a short. Entry near 79,800, stop loss at 80,100. That's a tight $300 stop. Target 1 is 78,500. Target 2 77,600. Risk reward on target 1 is roughly 1 to 4.3. On target 2 it's over 1 to 7. But I must warn you, you're trading against the potential trap and the macro drift. This only works if the S&P 500 simultaneously rolls over at resistance. If the S&P breaks higher, Bitcoin will slice through your stop like butter. This is a tactical scalp, not a swing conviction. Now the risk management pulse. Repeat this until it's muscle memory. Never risk more than 1 to 2% of your trading capital on any single idea. No positions through high-impact news events unless you've sized for chaos. Hard stops are non-negotiable. If your platform doesn't require you to set a stop, change your platform. That if you take away one thing from today's breakdown, let it be this. The level that decides everything for the next session is 79,025. A 4-hour close above it, and the bearish narrative fractures. We are targeting 81,000. A failure to reclaim it, and a break below 77,484, exposes 76,800 and then the deep liquidity pool at 74,000. It's that binary right now. Tomorrow we have the Federal Reserve meeting minutes dropping, and that will be a massive volatility event for both Bitcoin and the S&P 500. I'll be right here breaking down the exact levels before the news, so you don't get blindsided. That video will be live at the same time. Do not miss it. If you want the full breakdown on gold and oil, because we are seeing a fascinating inflation versus geopolitics divergence over there, that video is live now. Check the end screen. Smash the like button if this analysis gave you a clear plan for the session. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one.